been highlighting the re-rating potential of Karur Vysya Bank for quite some time and even recommended it as our tactical pick. From that level, the stock has rallied 56% against a 3% rise in the Nifty 50 index. Post a stellar Q1 performance, the stock rallied over 25%. Now, given the improving asset quality, resumption of growth, stable deposit base and steady improvement in the ROA, along with an undemanding valuation despite the recent surge in stock price, we see immense re-rating potential. Current volatility in the markets present a great opportunity to add the stock on every decline. With gross slippage of only 139 crores in Q1 FY23 and a negative net slippage for the fourth consecutive quarter, the asset quality pain appears to be behind. Now, consequently, gross and net NPA declined sequentially and the provision cover stood at a comfortable 65%. Management expects a modest slippage of not more than 1.5% of advances in FY23, riding on higher resolution, recovery and a negative net slippage. The bank is targeting to lower gross NPA to less than 5% and net NPA to less than 1% by the end of FY23. Although KVB has a sizable standard restructured portfolio of 1525 crores, which is 2.6% of the book, it carries an 11% provision on it and is not worried as it is largely secured. The overall stressed pool is down to 3.3% of assets at the end of Q1 from 4.3% in the year-ago quarter. Given that the economy is on the mend despite near-term headwinds from inflation, the bank expects to contain credit costs to 1% in FY23 against 1.25% in the previous fiscal. After many quarters, growth was visible with overall advances growing 14% YOY and 3.6% sequentially in Q1. Interestingly, the growth was supported by all the key segments, whether it's commercial banking, corporate, retail and agriculture that comprises mostly of gold loans. In addition to mid-market segment, which is not only relatively better yielding but also the key area of strength for KVB, retail is going to be a focus area with key drivers being housing as well as gold loans. The latter, of course, is risk-free as well as high yielding. The bank is confident of growing advances by over 15% in FY23. It is pertinent to note that the growth is coming with quality as reflected in the ratio of risk-weighted assets to total assets at a benign 50%. Amid the industry-wide challenge to build a competitive deposit base, KVB seems to be doing a good job, although this should remain a focus area even going forward. Overall deposits grew 10.5% year-on-year and 3.6% sequentially, with the targeted segment, low-cost CASA, growing faster at over 14%. The share of CASA at the end of June this year stood at over 36.4% of deposits, helping the bank bring down the overall cost of deposits. The bank going forward is targeting a CASA share of 40%. KVB has succeeded in meticulously building a retail-centric deposit base with 92% of term deposits coming from retail. The falling cost of deposits was a key driver of the sequential improvement in interest margin to 3.82% in Q1. While the cost of funds has little headroom to improve further, the bank is confident of maintaining NIMs above 3.7% despite the recent hike in deposit rates in some categories by 50 basis points, thanks to a better yielding non-corporate loan book, waning competitive intensity and 85% of the book being floating, while 30% linked to external benchmark that is getting repriced immediately. Operating expenses, especially employee costs, have been a point of bother for KVB, which makes its cost-to-income ratio uncompetitive compared to peers. With largely unionized employees, the cost structure hasn't been too competitive. However, as old employees retire and growth makes a comeback, this issue will also get gradually addressed. The bank is guiding to bring down the cost-to-income ratio to 50% in FY23, the early signs of which were visible in Q1. We see meaningful acceleration in earnings in the coming quarters riding on growth, stability in margin, improvement in cost-to-income ratio and lower credit cost on account of an improvement in the asset quality. The bank has reported an ROA of 1.09% in Q1 and is looking at an exit quarter Q4 of FY23 ROA of 1.15 to 1.2%. With a strong presence in the mid-market segment and adequate capital, we see discount to peer banks closing gradually as investors get convinced about the steady, predictable earnings trajectory of Karur Vysya Bank. Of course, there will be some risks to watch. Worsening of asset quality or slow growth due to the pandemic or economic slowdown should be some potential risks to watch out for.